Topic 3. Capital Structure Optimization. Capital structure optimization is one of the most critical responsibilities of the modern Chief Financial Officer (CFO), as it directly influences enterprise value, financial flexibility, risk exposure, and long-term strategic growth. Capital structure refers to the combination of debt, equity, and hybrid financing instruments used to fund an organization's operations and investments. The objective of optimization is not simply to minimize financing costs, but to identify the most efficient balance between risk and return that supports sustainable value creation while preserving financial resilience under changing market conditions. Traditional corporate finance theory suggests that organizations should seek an optimal capital structure that minimizes the weighted average cost of capital, WACC, while maximizing firm value. In practice, however, capital structure decisions involve multiple strategic considerations beyond mathematical optimization. CFOs must balance shareholder return expectations, liquidity requirements, credit ratings, taxation, regulatory constraints, financial flexibility, market conditions, and long-term strategic objectives. The optimal financing mix therefore evolves continuously as business conditions and corporate strategies change. Debt financing offers several strategic advantages. Interest payments are generally tax-deductible, reducing the effective cost of capital while allowing shareholders to maintain ownership control. Moderate leverage can enhance return on equity and improve capital efficiency when invested in projects generating returns above financing costs. Debt financing also imposes financial discipline by requiring management to maintain cash flow generation and operational efficiency. However, excessive leverage increases financial risk, refinancing pressure, covenant restrictions, and vulnerability during economic downturns or periods of market volatility. Equity financing provides greater financial stability because it does not require mandatory repayment or fixed interest obligations. Equity strengthens balance sheet flexibility, supports long-term investment programs, and improves the organization's capacity to absorb unexpected economic shocks. However, issuing additional equity may dilute existing shareholders, reduce earnings per share, and increase the overall cost of capital because equity investors generally require higher expected returns than lenders. CFOs must therefore carefully evaluate the trade-offs between preserving ownership value and maintaining financial flexibility. Modern capital structure optimization extends beyond the simple debt versus equity decision. Organizations increasingly employ hybrid financing instruments, such as convertible bonds, preferred shares, perpetual securities, mezzanine financing, sustainability-linked loans, and green bonds to achieve strategic financing objectives. These instruments provide additional flexibility while supporting environmental, social, and governance (ESG) commitments and expanding access to global capital markets. Strategic capital structure decisions must also align closely with corporate growth strategy. High-growth technology firms may prioritize equity financing to preserve liquidity and support innovation, while mature companies with stable cash flows may utilize higher leverage to optimize shareholder returns. Companies pursuing mergers and acquisitions require sufficient debt capacity and financial flexibility to execute transactions without compromising balance sheet strength. Consequently, capital structure optimization becomes an integral component of enterprise strategy rather than an isolated treasury decision. Liquidity management plays an equally important role in maintaining an optimal capital structure. CFOs must ensure that organizations maintain sufficient cash reserves, revolving credit facilities, and diversified funding sources to support operational continuity and strategic investments during periods of economic uncertainty. The COVID-19 pandemic, global inflation, geopolitical conflicts, and financial market volatility demonstrated the strategic importance of liquidity resilience and access to multiple financing channels. Strong balance sheet management enables organizations to pursue opportunities while competitors may be constrained by financial limitations. Advances in digital finance have significantly enhanced capital structure management. Artificial intelligence, predictive analytics, integrated treasury platforms, and real-time financial modeling allow finance leaders to evaluate financing scenarios under multiple economic conditions. Dynamic forecasting models can assess the impact of interest rate changes, currency fluctuations, inflation, credit market conditions, and macroeconomic shocks on cash flows and capital adequacy. These digital capabilities enable CFOs to make faster, more informed financing decisions while improving enterprise resilience. Capital structure optimization is increasingly influenced by investor expectations regarding sustainability and corporate governance. Environmental, social, and governance (ESG) performance now affects borrowing costs, investor confidence, credit ratings, and access to sustainable finance instruments. Green bonds, sustainability-linked financing, and responsible investment frameworks encourage organizations to integrate financial strategy with long-term environmental and social objectives. CFOs therefore balance financial performance with broader stakeholder expectations while maintaining disciplined capital management. Ultimately, capital structure optimization represents a strategic balancing act between growth, profitability, risk, and resilience. The modern CFO must integrate corporate finance theory, capital market expertise, treasury management, digital analytics, risk governance, and sustainability principles into a comprehensive financing strategy that supports long-term enterprise value creation. Organizations that successfully optimize their capital structure are better positioned to finance innovation, withstand economic uncertainty, maintain investor confidence, and achieve sustainable competitive advantage in an increasingly dynamic global economy.